When you look at the polls, American voters do not find deficits to be that problematic. When you look at the issues they're concerned about, it's not a top issue. So until that changes and becomes a top issue for voters, it likely won't become a top issue for politicians.
Hi, everyone. I'm Gunjan Banerji.
And I'm Telis, and this is WSJ's Take on the Week, the weekly show where we give you a leg up on the worlds of money and investing.
Last month, Telis and I were at the Wall Street Journal's Future of Everything conference, and we got some questions about tax policy. Here's one of them.
Hi, this is Kevin McPherson, Rochester, New York. I guess my question twofold. One, in terms of short term, when I listen to all of the discussion about tariffs, one of the things that somewhat surprises me is that it doesn't then relate to tax policy. So if I think about tariffs, then in some ways they are the opposite of the tax rebate, tax incentives, et cetera, that we have in the economy. Do you see the tariffs changing that tax policy at all?
We had some of the same questions, so we called in Mike McLean, Public Policy Senior Analyst at Barclays. Michael, thank you so much for joining us here today. I'm excited for this chat.
Thanks for having me. I'm excited to be here.
Tell us, it seems like the number one thing on a lot of investors' minds right now is the deficits and this big, beautiful bill in Washington right now.
Yeah, I mean, I think when it comes to conversations about like the treasuries market, which has been a big focus for us at the Journal and for investors, obviously, yeah, it's questions of government deficits, and what impact the budget bill will have. But I want to ask you, Michael, from a Washington and sort of policy point of view, how much of the Wall Street conversation that we have about the budget, how much is that actually like influencing day to day the policy discussion that they're having in Washington?
Right. So, I think the primary purpose of this bill and the politics around it is to extend the expiring provisions of the 2017 Trump tax cuts, the TCJA. Certainly, I get the sense that there is more discussion in Washington today about deficits and debt than there was in 2017 when Congress enacted the law to begin with. But I do think, from what I hear from clients, there's much more focus in the markets about the long-term sustainability of the fiscal trajectory that we're on than politicians are talking about in D.C.
So Wall Street is really concerned. Maybe Washington isn't as concerned?
I would say less concerned. I mean, there are certainly pockets of lawmakers. We saw this as the bill was moving through the House with some members of the Freedom Caucus who were having concerns about how much the bill would add to deficits over the next 10 years. But then we also saw in Washington that there was an equally vocal group on the other side who were concerned that the bill was cutting too much for some programs like Medicare, so Medicaid. So I think it's still kind of a mixed view in D.C. on deficits.
How big is the deficit that we're talking about? I've seen a few different estimates thrown out there. What number are you watching right now?
Right. So the House passed bill, as estimated by the Congressional Budget Office, they're the official congressional scorekeeper, would add $2.4 trillion to deficits over 10 years. And that's based on current law baseline. So under current law, a lot of the tax cuts are expiring at the end of this year, so extending them would add to deficits. What I hear often from clients is they look through actually the CBO number, and what they look at is what the number would be if everything in the bill was made permanent. Because there's a lot of new tax cuts, no tax on tips, no tax on overtime, a new deduction for Social Security that are just temporary. So markets look at it as what would this mean for the deficits if everything was permanent, and there you're looking at a number about $4 trillion. And that's before added interest expense. So then when you add in interest expense, you're looking at a number potentially as high as $5 trillion added to deficits over 10 years.
And historically, have we seen this level of spending when the U.S. isn't in a recession?
We have not seen this level of deficits if we're not in a recession or other type of time where you would expect the government would be spending more, war, recession. And this Treasury Secretary has said it's his goal over time to move the ratio of deficit to GDP from 6% closer to 3%. But I think when you look at this bill over the next 10 years, you see a trajectory where we're likely going to be in a world of $2 trillion plus annual deficits as far as the eye can see, which means we're going to be at that 6 to 7% of deficits to GDP ratio going forward.
So we are in uncharted territory in some ways.
We are. What's really driving the deficits are two things: entitlement spending and interest on the debt.
Define entitlements for us again. I
So-
know
so-
we throw that word around a lot, but what
Yeah.
exactly does that refer to?
It's the big three. It's Medicare, Medicaid, and Social Security. Then there are some other entitlement programs, but those are the big three. So when you look at revenue coming into the government, it's about 17% of GDP, and that's where it's been historically when you look back, over the decades. And actually, when you look at discretionary spending, so that's the non-entitlement spending, the spending that funds the appropriations for the government every year, that's around 6%, 6.3%. And it's, about where it was last year as it was pre-pandemic in 2019. So the two things that are driving it is this growth in entitlement spending as the population is getting older, and then increase in the interest expense as interest rates have moved up.
That explains why President Trump seems to want lower interest rates, right? That could save the U.S. a lot of money in terms of our interest expense.
Right. So if interest rates came down, the government could benefit from that in terms of lower interest expense. The joke in Washington is actually when you look at the federal budget, the government is really an insurance company with a military. Because that's how we spend our money, right? So much of it is for the entitlement programs, and many of those entitlement programs are health related. And then you have interest on the debt, and then the third big expense, of course, is defense.
How much of this comes down to views about the economic impact of the budget? Is there a debate that maybe this budget, and the reason maybe that we're more concerned about it, is that it's not going to have the same kind of economic bump, given that we are extending existing tax cuts rather than adding new tax cuts? I just want to know how much of the conversation is really about economic growth.
Right. So if we're going to try and get this 6% deficit to GDP ratio down, there's two ways you can do that, right? You can reduce the numerator by shrinking deficits, or you can grow the denominator by growing the economy. And I think right now there is a wide range of views in Washington about what this bill may do for economic growth. So if you look at the estimates from the White House Council of Economic Advisors, they're very bullish on what the bill may mean for growth. They say that it could add 3, 4, 5 percentage points to real GDP growth over the decade. When you look at the CBO number, it is much more conservative, right? They're looking at, marginal increase to growth, maybe, 40 basis points over 10 years. Our economists have taken a look at it, and their estimates are a bit closer to CBO's estimates. They're looking, say, well, maybe it could add 20 to 30 basis points of real GDP growth next year. So, I don't think we should necessarily be surprised if the bill did not add a lot to growth, because the real objective of the bill is to extend current tax policy. There are not really that many new tax cuts in this bill, and there's also a lot of spending cuts in the bill as well. So I think that's in part what drives maybe a little bit of the uncertainty or the range of views around growth.
I think that one reason that people are so keyed in on this budget is obviously there's a lot happening and a lot of changes taking place in government. But I also think that it's what happened in the UK a couple of years ago when they had the so-called Liz Truss moment where, the prime minister proposed a budget that had a lot of tax cuts, didn't necessarily raise a lot more revenue, would have involved issuing a lot more, UK debt, a lot more gilts. And the market really freaked out. Obviously, we've seen Treasury yields rise in the U.S. We've had a few kind of scary moments, a couple of auctions that spooked people out. I don't know if we've had that Liz Truss moment here in the U.S. so far. Do you think that's still a possibility, Mike, or have we kind of already absorbed the headlines and maybe, are going to move on basically from here?
I hear that question a lot from clients. I think the U.S. is different from the U.K. in a number of ways, and why that may mean that we don't get that same Liz Truss moment here, at least in the near term. The one reason I think predominantly is that the dollar is the global reserve currency. So as long as the U.S. government can run deficits because they're able to issue bonds and there's investor appetite to purchase those bonds, we can continue to run deficits. The issue in the UK, of course, was that investors did start to rebel and say, you're going to have to compensate us at a much higher yield if we're going to be purchasing this debt. And that just doesn't seem to have played out yet in the U.S. Right after the election, there was an increase in yields on longer-term treasuries. As the market, I think, began to already price in, even back in November, an extension of the 2017 tax cuts. But we haven't seen kind of that same magnitude that we saw during the Liz Truss moment when the government in the UK had to kind of then revise its budget. And when you listen to Secretary Bessent, he'll often point out that the 10-year yield right now is lower than it was on January 20th when the president took office.
So you mentioned clients ask you about this Liz Truss moment. How concerned are clients about these deficits and the big, beautiful bill? Like, what's the vibe out there in terms of what you're hearing?
I think investors are a bit confused because I think they went into the start of this year with the new administration, and whether it was all the conversations around DOGE and cutting government spending, the secretary's comments around moving to 3% deficit to GDP ratio, and then they look at the reconciliation bill and there's a bit of how does this all line up when we have a bill that's potentially adding to deficits over the next 10 years. The one thing that I think clients and investors are still, maybe the jury's still out on, is tariff revenue. Because that could be significant, right? And you hear that often now from the White House saying like, well, CBO scores the bill one way, but they don't account for the substantial tariff revenue that's coming in. They did a separate analysis of the president's tariffs and found that could raise, I think, $2.7 trillion in revenue over 10 years. So that could be a big offset to the one big beautiful bill. And I think clients are just uncertain about, as we all are, how long those tariffs are going to be in effect for, what form they're ultimately going to settle on, and that all will be important to understanding how much revenue they can generate.
Treasury yields have been crazy volatile, but they haven't moved that much since the start of the year. Investors always say that they're worried about deficits, but that's not reflected in the market. Why is that?
I'm always shocked, and maybe I shouldn't be at this point, but investors are so forward-thinking that much of this bill was priced into asset prices going back to President Trump's election in November. There was an expectation that we were going to get a reconciliation bill, we were going to get an extension of the tax cuts. And so in some ways, the market story for this bill is already behind us.
But people have been worried about deficits for years, if not decades. Like, when does this actually start to become a concern, if it does?
I think that's a great question for the bond markets. At what point do the bond markets decide enough is enough? And I don't think we're there yet. One date on the calendar to look at, and it's still 8 or so years away, is we just got recent updates from the trustees for the entitlement program saying that Social Security trust fund is going to go insolvent in the early 2030s. That will leave Congress with a decision it has to make, right? Either current retirees' benefits will be cut by approximately a quarter, or Congress needs to figure out some way to make the fund solvent again, right? And that could be structural changes to the program, or could mean a big bailout from the Treasury General Fund, right? But I think that for deficits longer term, we're going to need a moment that confronts Congress for Congress to act, rather than assuming that Congress will act preventatively to kind of do something. And the reason for that is just politics. When you look at the polls, American voters do not find deficits to be that problematic. When you look at the issues they're concerned about, it's not a top issue. So until that changes and becomes a top issue for voters, it likely won't become a top issue for politicians.
Well, let's dive into some more like kind of tax and more like sector-specific policy issues after we take a quick break.
With President Biden's Inflation Reduction Act, I kept hearing from investors that act made them more bullish on electrification and onshoring. Are there any big themes here that you think could emerge for investors from this bill?
Yeah, look, I think the one theme that could emerge is the administration and congressional Republicans really want to incentivize domestic manufacturing. And so there are a few provisions in the bill that are put in there to try and do that, right? One is the extension of immediate expensing for domestic R&D. Another is full depreciation for capital expenses like equipment and new factories.
And again, these are things that were in the 2017 Tax Cuts and Jobs Act. So these are extending a current tax policies.
That's right.
Okay.
Tax policies that were enacted in 17, some of them have already expired, and so it would be bringing them back. Others are starting to phase out, so eliminating the phase out and making them permanent. But that would be the goal, I think, of this legislation when you look at the corporate side, because there's no adjustment to the 21% statutory rate. So really what companies have at stake are some of these business provisions that I think are really focused on domestic manufacturing.
Recently, there was a big move in the shares of solar companies because it seems like, things are still in flux, but it looks like the direction of things, Mike, tell me if this is where you think they're headed, is towards taking out a lot of the tax credits that have gone to, solar and wind and other kind of renewable energies. So there is, I think, a big interest in the impact on, and part of the breakup of well, I don't know what their relationship status now is. It's complicated. Of Elon Musk and Donald Trump was about,
Right.
EV tax credits, right? Obviously, that's been good for Tesla. So what's the future for EVs, clean tech, et cetera, under this kind of new, under the One Big Beautiful budget?
Yeah. In the spring of last year, we published a note taking a look at what could happen to the IRA depending on the outcome of the election last year. I think what always made the IRA vulnerable if we had a Republican unified government was the fact that it was passed through reconciliation with only Democratic votes, right? And you can contrast that to something like the CHIPS Act that was passed with bipartisan support and so therefore is much more politically durable when you have electoral change. So the IRA was, I think, always going to be something that would get changed if Republicans had the opportunity.
So investors never really put all their eggs in that basket thinking, okay.
I think some of them did. I definitely heard from investors who were moving their money around based on the IRA.
Yeah, so I think what I hear from clients today is that the changes proposed to the IRA in this bill, may have a short-term impact in terms of demand for, investment in some of these renewable technologies if we lose some of these credits. But longer term, I think investors still remain quite bullish that aggregate electricity demand is going to grow so much that we're going to need to increase supply from all sources of energy, including renewables. And so regardless of what happens with the IRA, when you look at the long term, there's going to be kind of this structural demand for increasing investment in renewables.
There are a couple things that are also seem to be going down to the wire in terms of negotiations. One is, Medicaid. It seems like the Senate and the House, there's a lot of daylight on. It seems like senators are much more concerned about big cuts to Medicaid. There are a couple that have really kind of stood on that. And then the other is, and this is, of course, of great interest to those of us here in New York State, is the SALT deduction, the ability to deduct your state and local taxes from your federal taxes. Tell us a little bit about the politics of those things. Maybe they're even related. I'm not sure. It just seems like those are like kind of the big couple of debating points that may still get kind of reshaped as this thing moves towards its final form.
Yeah. What makes this bill challenging politically is the very narrow margins that Republicans have in the House and Senate. So they have a 3-seat majority in the House and a 3-seat majority in the Senate. And because reconciliation by its nature is a purely partisan exercise, it means that the entire team has to agree on everything, essentially, in order to have the votes to get it through. SALT's one issue that has divided the House Republicans because there are a handful of Republicans who represent states like New York and New Jersey where the SALT deduction is important. So there was this fine-tuned compromise that was reached in the House to raise that from $10,000 to $40,000. The Senate has taken a different view on that, and so I think that's one of those probably points that will be one of the last remaining sticking points to be resolved, but it needs to be resolved because otherwise there won't be the votes in the House to get the bill across the finish line. The Medicaid cuts are likewise, right? Again, you have members on both sides of that issue, some that feel that we're not making enough cuts and others that feel like we're making too many cuts, right? And again, that's an issue that they're still going to have to hash through and see what compromise they can come to.
And obviously that's impactful to, people who, either live in a high tax state or who are, rely on Medicaid. But from an investment or economic point of view, would you say that these are also sort of ultimately marginal to kind of how the markets or specific investors or maybe, your economists view this budget? Or are those like really important to, the deficit impact or the macroeconomic impact or the sort of sector impact of this?
So on SALT, it's just I think an issue of parochial interest to New York-based investors. So I get asked a lot about it. I think it's because people are interested about how it impacts their own taxes. But Medicaid cuts, I think, are more impactful when you take a look at the macro impact of the bill, right? So the House bill would cut spending by 1.6 trillion over 10 years, and about 700 billion of that 1.6 trillion comes from changes to Medicaid. So it's a big part of the spending cuts that are part of the bill, and so any changes to that potentially moves that aggregate spending cut number, and then that has implications for how much the bill may add to deficits over the 10 years. So I think a lot of this is much more art than science.
We're going to take one last quick break, and then when we come back, one more question for Mike McLean at Barclays.
Welcome back. So, Mike, does the One Big Beautiful Bill, does it help businesses more or individuals more?
I think it helps individuals more. So much of this bill is really focused on individuals. And I think that is, in some ways, the biggest difference from 2025 to 2017. 2017 was all about businesses in terms of tax reform. 2025 is all about individuals.
Well, we've got the early 2030s circled on our calendar. I'm sure politics will sort itself out and everyone will rapidly agree on how to deal with those things when they emerge then. Mike, it's been a great conversation.
Thank you, Mike.
Thank you. That's the intent, that the provision would never come into effect because the U.S. would be successful in negotiations to get other countries to level the playing field on taxes.
Speak softly and carry a big tax stick, I guess.